Fundamentally, there are two questions that every farmer needs to understand. The first one is, what's the capital gains exemption and how do I use that? And the second one is, what are the special farm rollover rules and how do they apply to me? And so the purpose of this video is just to provide you with an understanding of those two separate rules and how they apply, starting with the farm rollover.
The general rule is everyone is deemed to sell everything at fair market value if gifted or sold for less than fair market value on death. There's only two exceptions: when you roll to a spouse, or in the case of farmers, when you use a special farm rollover rules. How do you keep farm property within the family, and how can you ensure that the next generation is able to carry on the farming legacy without having to pay huge amounts of tax when the value of land continues to increase so significantly? Well, you roll it on to the next generation. What do I mean by rolling? Well, roll means a gift that is a tax-free transfer at the transferor's cost base. Section 73 in the Income Tax Act carves out a special rule for qualifying farm property. It allows people owning farm property the ability to gift the property to their children or grandchildren tax-free, with the child or grandchild taking over the parent's low cost base. And then Section 70 allows for intergenerational transfers of farm property upon death. This is a huge advantage for farmers. If farmers didn't have this special exception, then any transfer, whether it's to the farmer's children, grandchildren, or further down the chain, would be deemed to occur at fair market value. That would trigger a significant amount of tax. How is that next generation going to be able to pay for all of that tax, especially when they're just getting started in many cases? For most people, it would be impossible. They'd have to sell some land just to pay that big tax bill. Who does the farm rollover apply to, and what can be transferred? Well, you can transfer the qualified farm property to any Canadian resident child, grandchild, or further down the line. If one of your children is a U.S. resident, it wouldn't matter if they are also a dual citizen. Any transfer to a non-resident is going to be deemed to occur at fair market value, and that will most likely trigger tax. The test to determine whether the land qualifies for the rollover is pretty simple. How many years has the land been farmed by members of the vertical chain versus how many years has it been rented? The years farmed must exceed years rented. But it doesn't have to be you yourself actively farming the land. You can rely on your spouse, your parents, your grandparents, even great-grandparents. If any of them were actively farming the land, you can count those years towards your years farmed. The catch here is there can't be a break in the vertical chain. I said to qualify the land, it needs to have been farmed more years than it's been rented. So here's a diagram that gives you an example where the land's been owned since 1922. You can see it's been owned for 100 years. It looks like it was farmed for the first 40 years, then rented for 20, farmed again for 10, and then the last 30 years it's been rented out. When you do the math, that's 50 years farmed versus 50 years rented. As of right now, the land would not qualify for the farm rollover. The land needs to be farmed more years than it's been rented. But it would be easy enough to qualify this particular parcel and to get it back on side. If you, your children, or your grandparents are not going to be actively farming, you could instead enter into a custom farm agreement where you take all the risk. So by now, I hope you understand kind of the basic idea of the farm rollover. Was the parcel farmed more years than it's been rented? Simple. I want to build off of that now and introduce another concept, the vertical chain. Before I do, I need you to understand the vertical chain is not a test. Capital gains exemption, that's a test. If you satisfy the test, you get your capital gains exemption. Farm rollover is a test. If the parcel was farmed more years than it's been rented, you get the farm rollover. Those are tests. The vertical chain, it's just a concept. It tells you what years you get to count and when the counting restarts. It's going to apply equally both to the capital gains exemption test and to the farm rollover test. I want you to think of it like a jar of elastics. Okay, I could ask you to test the stretchiness of each elastic in the jar, or I could ask you to count how many of those elastics you can place on a thumbtack without any of those elastics falling. Two completely and entirely different tests. One doesn't have anything to do with the other, but in both of those tests, I'm using the same elastic. So the vertical chain is kind of like that. It tells you the span of years that you get to look to qualify the land both for the farm rollover and the span of years that you get to look at when it comes to qualifying the land for the capital gains exemption. Again, two completely different tests, but I'm looking at the same time interval when determining whether the land qualifies in either of those two tests. So vertical chain is telling me what years I have to look at. And the key here is, and what you're going to hear me say time and again today, don't break the chain. Because as soon as we break it, we start back at zero. We can't rely on any years that predate the break in the vertical chain. And so this illustration here is helpful. You can go down, but you can never go sideways. And we see that all the time where it goes from one brother to the other brother, and it effectively breaks the vertical chain. You think that it's always stayed in the family, but the moment that it went from brother to brother, that chain actually broke and you restarted your timeline. So as long as it's, like we see in the left-hand column here, grandparents giving to down to parents, down to children, down to grandchildren, you can continue to draw boxes down. That's fine. That's all lineal. There aren't any breaks. It could also skip generations and go from grandpa down to grandchild. So when we're talking about the years farmed versus years rented, we're relying on grandpa having farmed. As long as there's no break in the chain, then we're okay. We can count all of those years grandpa farmed during that time interval. And that's what we see in the left-hand column. If we turn then to the right, where grandpa had the land, it went down to daughter, and that would have been fine. That's lineal. But then as soon as the daughter transferred the land over to her niece, it doesn't matter how long the land's been in the family. As soon as that transfer goes from aunt to niece, the chain is broken. Meaning we're not going to be able to count any of those years that predate the break, even if grandpa had been farming for 50 years, right? None of those years count. The historical timeline restarts effective as at that break. Still looking at that broken diagram on the right, because you cannot use the farm rollover on a transfer of land to a niece, that transaction will be deemed to occur at fair market value. If someday the niece wants to leave this land to her children, unless a niece has been actively farming the land for more years and she's been renting it, she's not going to be able to roll that land down to her children either. And even if the niece does decide, well, I'll just sell the land then at fair market value, unless she can meet the capital gains exemption test, either by farming the land herself or custom farming, she's also not going to be able to use her capital gains exemption because she can't count any of the years that predate that break in the chain. If you break the chain, all you can rely on is what's in your hand. It's quite literally like cutting a rope. You're not going to be able to go up, and you can't rely on any earlier generations having formed. Or to go back to that analogy that I gave you earlier when I said the vertical chain is like a jar full of elastics, the moment you break that vertical chain, the jar goes back to being empty. There are no years to count. There is no time interval to select from. And you can't qualify the land for either of the two tests because there's no years to look at. It's a total and complete reset. It'd be like buying it from a stranger. Staying with the farm rollover, that's why establishing that timeline for each of the parcels is so important. And that's also why you have to be careful when you're transferring land over, because you don't want to break that chain. Under the current rules, if you can maintain that vertical chain, the rules are very favorable. If grandpa and great grandpa were farming for 60 years, it doesn't matter that you and your parents have never farmed the land. Even if you've been renting it for the last 20 years, you still have another 40 years before the land no longer qualifies. And that's assuming that the rules stay the same way that they are right now. A little bit later on, I'm going to explain some of the reasons why we often recommend transferring during your lifetime and the different ways we can achieve that, including using the capital gains exemption in conjunction with the farm roll to bump up your cost base. The other way to do this would be to use the farm rollover on death. And with the high price of land, you almost have to roll it down because if you were deemed to dispose of the land at fair market value, and especially if you've already used up all of your capital gains exemption, or if the capital gain on the land exceeds what's left of your capital gains exemption, then the estate is going to have to pay a significant amount of tax on that gain. So we talk to a lot of farmers, and most of them have a pretty good idea how the farm rollover is supposed to work. They think that because they are farmers, they should be able to give the land to their children, and the children shouldn't have to pay any capital gains tax. But what they don't realize is how technical this rule is. there is very specific language that the lawyer must use in order to ensure that all of the criteria have been met. This is a major risk to any family farm. If the will is not properly worded, your estate could end up having to pay tax on any capital gains above your remaining capital gains exemption balance. It's a mistake that can easily occur if the lawyer drafting your will isn't familiar with farm tax planning and the rules governing the farm rollover. As a lawyer, I can fix a lot of things, but there's no fixing a will after that person has died. The estate is stuck with the will at that point, and the majority of the wills that we see are not drafted correctly and would not qualify for that farm rollover. And by now, I hope you see why that's a big problem, and why you need to speak with a lawyer knowledgeable in farm tax.
Now that you understand the farm rollover, which is really just effectively deferring tax. So rather than me paying tax when I dispose of this property or my estate having to pay that tax, we're effectively just transferring those assets down to my children at my current cost base. We're kicking the can down the road so that eventually either they or their children will have to pay the tax owing. Then your next question is most likely going to be, because I have $1 million of capital gains exemption anyways, is there a way for me to be able to utilize that, increase their cost base, and ultimately reduce the amount of tax that they eventually have to pay? And the answer to that is yes, but you just have to understand the capital gains exemption and how it applies.
So this slide gives you a little bit of a background history about the capital gains exemption. We haven't always had it. It was given to us in 85, and then there's been several variations. When it came out, it was $500,000. Then in 94, the inclusion rate for capital gains was changed to 75%. Currently, it's up to $1 million. And the inclusion rate is sitting back at 50%, which means $500,000 of taxable capital gain is being sheltered under this special farm exemption. Everybody gets this, but only a small percentage of people are ever able to use it because you either need to be a farmer or own shares of a qualified small business corporation. The exemption can be applied to farmland, shares in a qualified farm corporation, interest in a qualified family farm partnership, and certain specific assets like quota. There are a lot of definitions within the Income Tax Act, and one of them that keeps coming up is farming. What is actively farming? What is used in farming business? Quite often the definition that's more helpful are the ones that tell you specifically what farming is not. I don't want to get overly technical with definitions, but one thing we see all the time are people who are crop sharing. Crop sharing is considered to be rental income, meaning you won't be able to count those years as farming years, and it won't count towards qualifying the farmland. If you're currently in this sort of arrangement, and especially if you're getting close to being put offside in your years farmed versus years rented, you may want to consider entering into a custom farming arrangement. What are the requirements, and how do we qualify for the capital gains exemption? Let's look at the test now. And the test is going to be different whether we're dealing with farmland or shares. But for personally held farmland, I've highlighted the general rule. Typically, the test is going to be, did you own the property for 24 months before transferring? And did you farm the land principally for any 2-year period where the gross revenue from farming exceeded your net income from all other sources? The test is slightly different if the land was acquired before 1987, in which case the land would have needed to be farmed any 5 years, and those 5 years wouldn't need to be consecutive, and there's also no income test. Okay. So I said you need to be farming land for 2 consecutive years, but just like when we were discussing the farm rollover and how you were able to rely on your parents, grandparents, and even great-grandparents, here again, you might never have farmed the land, but if someone in that vertical chain of land ownership can satisfy this test, then the land's going to qualify and you're going to be eligible for the full $1 million capital gains exemption. Remember, the vertical chain informs us as to what years we can use, and as long as the vertical chain hasn't been broken, we can qualify the land for the capital gains exemption based on any 2 consecutive years of farming within that time interval of our vertical chain. And it's interesting how many lawyers and accountants advise their clients that their land or their shares don't qualify when they do, based on past generations having farmed. Again, that's why it's so important to be speaking with an advisor that understands these special rules. I'll also note here that using your capital gains exemption could trigger AMT and clawback of OAS and CPP. These are transactional costs that you may incur when you utilize your capital gains exemption, and we would discuss these with you and your accountant and come up with a plan that minimizes these transactional costs. When I'm talking about AMT, that stands for alternative minimum tax. It's a tax that you're paying in advance after having avoided paying tax on the capital gain. If you have high income, you can get that AMT back over the next 7 years. And you might also be able to get it a little sooner by pulling out certain retirement investments as well. Another option would be to claim a reserve to spread out that gain, and instead of triggering all of that gain in the 1 year. On a sale to a child, that can be spread out over 10 years, and often that can reduce or eliminate any AMT altogether. If you're receiving OAS and CPP, you're going to be dealing with clawback as a result of you now having to report that higher income on the sale that's being triggered. And we would work with you and your accountant to run these calculations and help you decide how best to structure the sale, whether it's 1 year, whether it's spread out, and what those transactional costs are going to look like. Any person acquiring an interest in land would also need to get a GST number and self-assess at fair market value. But that's just an in and out on their GST return. They don't actually pay the GST. I suppose if they don't obtain a GST number, then the vendor or the person that's gifting the land, the parent, must collect and remit the GST at fair market value. So that's why we would just self-assess and get a GST number. Another cost you would see, unless the person acquiring the interest is going to be farming the land, would be land transfer tax, right? But it's important to note that these costs pale in comparison to the tax savings that you're creating. And it doesn't have to be just mom and dad that are paying all of these additional expenses. Usually it's the kids that are deriving all of the benefit because now they have that higher cost base. And there's no reason why the kids can't be paying for some or all of these costs, when doing so is going to make them so much better off. When I looked at this the last time I was explaining the farm rollover, this time I want to show you how we can use the vertical chain to determine whether the land qualifies for the capital gains exemption. So thinking back to that slide with the scissors, mom and dad, grandma, and even great-grandpa could have been farming the land, but as soon as there's a transfer that breaks the vertical chain, as soon as the rope gets cut, everything resets to zero. And if the person acquiring the land at that time hasn't been farming after the transfer, then the capital gains exemption will not be available to them. If we look at the left-hand side, the one that I've outlined here in green, grandma could have farmed the land for 6 consecutive years before retiring and renting the land for the next 60 years. No problem, because grandma farmed those 6 years where her only income was from farming, or if it was grandpa farming and grandma was a spouse of a farmer, we're okay. The land's going to qualify for the capital gains exemption. We're able to rely on those years. Technically, we wouldn't have to worry about the income test if the land was owned prior to June 1987. But if we look at the, so looking at this now, we can use the green box. We can use the capital gains exemption in the green box here. And so when it goes from grandma to parent, we could use our capital gains exemption there. When it goes from parent to adult child, again, we'd be able to use the capital gains exemption. And moving forward, you can imagine more boxes below that one, great-grandchildren, great-great-grandchildren, and everybody being able to rely on that, assuming that the rules do not change. So for the capital gains exemption, we don't have to do anything because the vertical chain was never broken. We can rely on grandma having farmed. But compare that to the right-hand column where it goes from grandma to parent to brother or to the brother of the parent there. And if we assume, again, the same fact pattern where grandma farmed for 6 years and it's been rented ever since, we're going to be out of luck on this one because the moment that the land transferred, as soon as we went sideways from parent to brother, we broke the chain. So if in that case there, if brother wanted to rely on the capital gains exemption, then he's either going to have to farm it himself or enter into a custom farming agreement in order to qualify it. And while there may not be any lifetime capital gains exemption on land held that by a corporate entity, we can sell the shares rather than the farmland and use the capital gains exemption if the corporation qualifies as a family farm corporation, which would create a shareholder loan that you can draw from your farm co tax-free. The test for qualifying farm property in a corporation is slightly more complicated. You would make a list of all of the assets held by the corporation and confirm whether each of these assets qualify. At the time of the sale, more than 90% of the fair market value of all assets held in the corporation must be used principally in the course of carrying on a farming business. If you have too much cash in the corporation, maybe you have agri-invest, it's easy to get pulled offside. For example, you could own $1 million in land and have $200,000 worth of cash in your corporation, and you're not going to meet that 90% test. You're going to have to do something to purify the corporation, which usually isn't that hard. It just takes planning. The second test that you also need to satisfy, at least 50% of the corporation assets need to have been used in active farming for any 2-year period. This is usually an easier test to satisfy, and it's a whole lot easier than trying to use your capital gains exemption through a qualified small business corporation, which would actually require that the 2-year period be the 24 months immediately prior to the sale. But it is still possible that you could have more cash than land. Like if the corporation was holding one parcel and a bunch of farm equipment had just been sold, for something like that, it could result in you needing to hold the shares for 2 years after the dividends have been paid out, and possibly also custom farming if you're not actively farming, in order to ensure that the used principally test is in fact met. So I like to think of it like a shopping cart, and over the years you're probably going to walk through the aisles, you're going to put some things in, and you're probably going to take some items out. But when it comes time to check out or to cash in those shares, instead of it being a 10 item or less line, the test is going to be, are you using 90% of your groceries for farming? And if you're not, then we'll help you take some of those bad groceries out of the cart so that you can get your corporation back on side. Again, we'd still need to make sure that at least 50% of the assets were used principally for farming for a 24-month period. But as long as you're not buying and selling it within a 2-year span, more often than not, we're going to satisfy that test. Okay, so what are those bad assets? What don't you want to be holding? You need to avoid holding large cash reserves in your corporation. That's really important. There's a lot of things that can put you offside, and you need to be really careful. It's going to depend on what the plan is and when you intend on redeeming the shares and using the capital gains exemption on those shares. Just because your lawyer and accountant have your corporation on side today doesn't mean that you're not going to have assets that pull you offside in 5 years. And you have to look at everything on an asset by asset basis. Going back to that shopping cart analogy, you're going to look at every item that you put in that cart and determine whether that's a good asset or a bad asset. Each of those parcels will be counted separately. So if the corporation owns one parcel and it's renting, that parcel is going to count against it, and so would co-op equity, Visa. And so you could have a parcel of land in the corporation that was farmed and has also been rented, and maybe it qualifies now, but if you rent the land out for another 5 years, then it will have been rented for more years and farmed, making this a bad asset, and it could end up throwing your whole corporation offside. So in that instance, you could custom farm that parcel or maybe sell the parcel before it pulls you offside. There's a lot of ways to purify a farm corporation and bring it back on side, but it's just something to be mindful of. And the thing that makes the 90% at the time of sale requirement so hard is sometimes you don't know when that sale is going to take place. So if you die, that's a deemed disposition. And is your corporation satisfying the test at that time? Usually the easiest way to keep your corporation on side, and my advice would be just speak with your accountant. They're the ones that see your financial statements anyways. You should be confirming with them each year that your shares are still going to qualify. And I'll say it again, so much easier to proactively plan ahead and deal with the future problems before they become problems, as opposed to retroactively trying to fix these complicated scenarios.